You know that ad that pops up every time you watch a finance video? The one where some guy in a Lamborghini says he made a fortune trading Forex. Yeah, let's talk about that guy and why his car payment probably comes from your losing trades. Because here's the uncomfortable truth. The Forex world has a shadow side, a machine that quietly eats retail traders alive, one pip at a time. I'm not talking conspiracy theory. I'm talking the real business model that keeps this entire industry running, and spoiler alert, it isn't your success. Every day, millions of people log into slick trading apps believing they're playing the same game as the pros. But the truth? You're playing poker at a casino where the dealer owns the cards, the chips, and the table, and the dealer wants you to keep playing until your wallet's empty. Sounds dramatic. Stick around. By the end of this video, you'll see exactly how brokers profit when you lose, why 90% of traders fail, how fake gurus sell the dream, and how giant institutions quietly move prices behind the curtain while you think you're in control. Let's start with the big one, the hidden business model. Ever notice that your broker's website says, trade commission free? Cute, right? Here's what they don't mention. Many brokers aren't just matching your trades, they're taking the other side. It's called the B-book model. When you buy, they sell. When you sell, they buy. So every time you lose a trade, they win. Let that sink in. In Australia, regulators caught a few firms doing exactly that. One company made millions because, and this is an actual quote, the broker profited when customers lost money. Translation, they literally built a system designed for your failure. And it's not just down under. In the US, FXCM got slammed with multi-million-dollar fines for secretly pocketing client profits while letting customers swallow the losses. Same playbook, different zip code. So the next time your trade stops out at exactly the wrong moment, ask yourself, was that the market or your broker's risk desk pressing a button? Now you might think, okay, maybe a few bad actors. Surely most traders still make money, right? Let's look at the stats. Across the US and Europe, roughly 2 out of 3 retail traders lose money every single quarter. In Europe, regulators say the number's closer to 80%. That means if you're watching this with 4 friends who all trade Forex, only one of you is ahead, and even that might be temporary. Why does almost everyone lose? Because the system is built on 3 things: leverage, emotion, and delusion. Leverage first. The marketing says, control $100,000 with just $1,000. Sounds powerful. In reality, it's like giving a toddler the keys to a Formula One car and hoping for the best. A 10-pip move against you, and boom, margin call. Then there's emotion. Every green candle releases a little dopamine hit, that sweet chemical that whispers, you're a genius. Lose a trade, and cortisol kicks in, yelling, win it back. That's how traders go from smart analysis to full-blown casino behavior in about 3 trades. And the delusion? Everyone thinks they'll be the exception. The one who outsmarts the market. The one who turns $500 into $50,000. Meanwhile, brokers are quietly smiling, because statistically, they've already seen this movie, and they know how it ends. But wait, the rabbit hole goes deeper. While retail traders battle emotions, a whole ecosystem of scammers is waiting in the shadows. You've seen them, flashy Instagram gurus with rented supercars, Telegram signal groups, promising 99% accuracy, YouTube ads screaming guaranteed profits. Here's the secret. Many of them don't even trade. They make money selling you the dream, or worse, directing you to a shady broker that kicks them a fat commission every time you blow up your account. In the US, one group ran a $300 million Ponzi scheme disguised as a Forex fund. They didn't trade a single lot, they just used new investors' money to pay fake profits to old ones. Classic scam, new packaging. It's easy to laugh at victims until you realize how convincing these operations are. Slick websites, fake testimonials, even AI-generated analysts posing as fund managers. They speak your language, literally, and they prey on greed and hope. Because the Forex industry doesn't just sell trades, it sells dreams. And if you think that's the end of the dark side, buckle up. In the next section, we're diving into the psychology that keeps traders hooked, the addiction cycle that turns smart people into chart-staring zombies at 2 a.m. Because once you understand that, you'll see why this market doesn't need to manipulate prices to take your money. It just needs to manipulate you. Let's talk about the real battlefield. It's not the charts. It's not the news. It's the space between your ears. Because Forex doesn't just drain your balance. It rewires your brain. And that's by design. Every time you place a trade, your brain releases dopamine, the same chemical hit you get from a slot machine or a social media like. That tiny rush says, do it again, and again, and again. You win one trade, you feel invincible. You lose one, you feel attacked. So you chase the next trade, not for profit, but for relief. That's not strategy. That's addiction with a chart interface. Now add leverage to the mix. Leverage is the dealer handing you a bigger stack of chips and whispering, go on, you've got this. And when it goes wrong, when that candle spikes the other way, the same leverage amplifies your pain tenfold. But here's where it gets truly sinister. The industry knows this. They study it. They literally hire behavioral scientists to design platforms that keep you trading longer. Ever wonder why your app lights up in green when you win and red when you lose? That's not decoration, that's operant conditioning. They're training you like a lab rat. The notifications, the confetti when you close a winning trade, the little try again pop-ups after a loss. Every click, every swipe, every sound is engineered to trigger emotion, not logic. And once your emotions run the show, the math stops working. Because fear doesn't calculate. Greed didn't use stop losses. Ego doesn't check the economic calendar. Meanwhile, the algorithm on the other side of your trade doesn't feel a thing. It doesn't panic. It doesn't revenge trade. It just executes perfectly, instantly, relentlessly. Let's be honest, most traders don't blow their accounts because of bad analysis. They blow up because they couldn't close a losing position when they should have. They froze. They hoped. They prayed. Then they watched their margin evaporate and told themselves the same lie every gambler tells before the last spin. Just one more trade. And here's the brutal twist. When you finally decide to quit, when you're emotionally drained, financially bruised, done with it all, that's usually when the market gives you one perfect trade. It pulls you back in, just to remind you how it feels to win. The hook resets. The cycle restarts. Because Forex, for most people, isn't a career. It's a casino disguised as an opportunity. No, not everyone loses because of psychology alone. Some people lose because the entire playing field is tilted against them by people they can't see, in places they'll never visit. In the next section, we're going inside that hidden world, the institutions, the algorithms, the invisible giants that move trillions while retail traders think they're moving markets. This is where it gets technical, shocking, and just a bit terrifying. Because once you see how the system actually works, you'll realize retail traders were never invited to win the game, only to fund it. Now let's zoom out. Way out. You'll meet the millions of retail traders. We're the small fish. The real ocean of Forex is controlled by banks, hedge funds, and machines that trade faster than you can blink. Every day, over $7 trillion changes hands in the currency market. Sounds massive, right? Here's the catch. More than 90% of that volume has nothing to do with retail traders. It's banks trading with other banks, institutions hedging billion-dollar positions, and algorithms hunting micro-profits at the speed of light. So when you think you're trading euro to US dollar against the market, you're actually trading against a system that can see deeper, move faster, and hit harder than you ever will. Let's start with the banks. They're not just participants, they are the market. They quote prices, decide spreads, and sometimes even nudge prices to trigger liquidity. They know where the big stop orders sit because they hold those orders. They see flow in real time. You don't. Then there are the liquidity providers, the silent middlemen connecting your broker to the interbank world. They aggregate prices, but they can also skew them. If volatility spikes, they simply widen spreads or pull liquidity altogether. And when that happens, your broker's platform suddenly freezes. You know that moment where you click close, but nothing happens? Yeah, liquidity just disappeared. For them, it's business. For you, it's a margin call. And now meet the algorithms. The high-frequency traders. They don't drink coffee. They don't sleep. They live in data centers next to the exchange servers, measuring latency in microseconds. While you're staring at a 5-minute chart, they're firing thousands of trades per second, exploiting tiny price differences invisible to the human eye. Their edge isn't talent, it's physics. They're faster. Always. A few milliseconds after a central bank headline drops, these bots have already reacted, repositioned, and profited. By the time your platform updates, the move's over. You're trading leftovers. It gets worse. Sometimes these institutions deliberately hunt retail positions. Ever notice how price spikes just enough to hit your stop loss, then reverses instantly? That's not bad luck. That's liquidity hunting. Big players push prices into zones packed with small stop orders, trigger them, then ride the reversal with fresh liquidity. It's legal. It's efficient. It's brutal. And you'll never see it coming. Even central banks shape the battlefield. When the Swiss National Bank removed its euro peg back in 2015, the franc exploded 30% in minutes. Thousands of retail accounts went negative instantly. Brokers collapsed overnight. Meanwhile, the institutions hedged or exited in seconds. The pattern is clear. The deeper you go, the more you realize retail traders aren't competing in the same arena. They're in the bleachers, thinking they're on the field. Now you might be thinking, okay, fine, so the big guys control everything. What about regulation? Someone's watching them, right? Good question. Because if you think the regulators have this under control, you're in for another surprise. So, who's actually keeping this global casino in check? You think with all the billions flying around, there'd be an army of regulators standing guard. Spoiler alert, there isn't. The Forex market is a legal no man's land. No single body controls it. No central exchange. No universal rulebook. It's every country for itself. That means a broker in Cyprus can sell to a trader in London who funds an account in crypto through a payment processor in Dubai, all before breakfast. Try regulating that. Sure, watchdogs like the FCA, ASIC, SISEC, and the CFTC do what they can. They find, suspend, warn, repeat. Affects CM? Fine. Affects DD? Fine. Trade Fred? Fine. And yet, every year, new brokers pop up with the same tricks, just a new logo and a different offshore license. Because here's the dirty secret, the fines are tiny compared to the profits. A few $1,000,000 for a company making hundreds of millions a year? That's not punishment, that's a business expense. Even when regulators win, the system barely flinches. A broker gets banned in one country, they just rebrand somewhere with looser rules. Belize, Vanuatu, St. Vincent, take your pick. By the time regulators catch up, the money's already gone. And while the agencies are bogged down in paperwork, the scams evolve faster than ever. Telegram signal groups, deepfake influencers, fake news sites linking to clone brokers. The tech keeps moving, the laws don't. Let's be fair, though. Regulators have stepped up. Europe capped leverage. The UK forces brokers to show that brutal risk disclosure. 80% of retail accounts lose money. But here's the irony, they've basically legalized the statistic. It's right there on the homepage. They tell you you'll probably lose, and then invite you to sign up anyway. Meanwhile, offshore brokers ignore all of it. They offer 1:1000 leverage, no verification, and fake testimonials of real traders who supposedly double their accounts. And people fall for it because the ad doesn't say offshore. It says freedom. It's whack-a-mole on a global scale. The watchdogs can't be everywhere, and the foxes keep building new henhouses. But here's where it gets interesting. Not all brokers are villains. Some are genuinely trying to build transparent, fair platforms. They segregate funds, publish execution reports, and follow real compliance standards. The problem is they're competing against the cowboys, and cowboys have better marketing. So where does that leave us? Somewhere between trust and chaos. A few good actors holding the line, and a crowd of shady operators dancing just outside the law. And in that mess sits the average trader, hoping that this time, with this broker, with this strategy, things will be different. In a minute, we're going to talk about what you can actually do to survive this system, how to play smarter, protect your capital, and spot the traps before they close. Because knowing the problem isn't enough. You need an exit strategy from the dark side. All right, you've seen the dark side, the brokers who profit when you lose, the scammers who sell fake dreams, the regulators who can't keep up. Now it's time to talk about how to beat the system, or at least how not to get eaten by it. Because here's the good news, surviving in Forex isn't impossible. It just requires a mindset shift that 95% of traders never make. Step 1. Pick your battlefield wisely. If a broker isn't regulated in your country, stop right there. Don't fall for the slick website or the trusted since 2012 tagline. Go straight to the official register, FCA, ASIC, NFA, whichever applies to you, and verify that license number yourself. If you can't find it, it's not real. Simple as that. And if a broker only takes deposits in crypto, run. That's not innovation. That's a digital escape route for your money. Step 2, risk management isn't optional. Most people treat stop losses like suggestions. Big mistake. The stop loss is not a limitation. It's a seatbelt. You can drive without it until you crash. Never risk more than 1% of your capital on any trade. That's not conservative. That's survival math. You might get lucky once or twice, but long-term, luck is not a strategy. Step 3, master your own psychology. You can't control the market, but you can control yourself. If your palms sweat every time you open a trade, you're over-leveraged. If you stare at charts all night, you're not trading. You're gambling with extra steps. Here's a trick. Before every trade, ask yourself, if this loses, will I feel emotional pain? If the answer is yes, your position size is too big. Cut it. You're here to make decisions, not emotional reactions. Step 4, stay allergic to hype. If someone promises guaranteed profits, secret algorithms, or zero-risk trading, they're lying. If they flash cash or cars, they're selling you something that isn't Forex. Real traders talk about drawdowns, risk per trade, and process, not private jets. You'll never see a real pro yelling, "Join my signal group," on TikTok. You'll find them quietly compounding returns and ignoring the noise. And step 5, play defense like it's offense. Your first goal in trading isn't to make money. It's to not lose it. Stay in the game long enough to learn how the game is played. Every dollar you protect is one the system doesn't steal. Now, I'm not saying Forex is all doom and gloom. There are legitimate brokers, honest educators, and skilled traders who make a living from it. But they treat it like a business, with discipline, data, and zero emotion. The dark side thrives on ignorance. The more you understand how the system works, the less power it has over you. And remember this. In Forex, you're not just trading currencies. You're trading psychology, patience, and probability. The sooner you accept that, the sooner you stop playing the game and start mastering it. Let's wrap this up. After everything we've uncovered, the brokers, the scams, the psychology, the algorithms, one question remains. Why does this system still exist? Simple. Because it's profitable for everyone except the majority of traders. Think about it. Brokers make money on spreads and client losses. Scammers make money selling fake strategies. Platforms make money on transaction volume. Influencers make money on affiliate deals. And regulators make headlines when they fine someone, even though the fines barely scratch the surface. The only person not guaranteed a profit is the trader actually taking the risk. It's the perfect business model. An endless conveyor belt of new hopefuls, each believing they'll be different. They won't make the same mistakes. They've done their research, but the system doesn't need everyone to lose forever. It just needs enough people to keep feeding it. The Forex market survives because it's addictive, glamorous, and invisible. It doesn't leave the paper trail of a casino. There are no flashing lights or slot machines, just numbers on a screen. And that illusion of control is the most dangerous drug of all. When you win, you think you're smart. When you lose, you think you're unlucky. Either way, you stay hooked. Because deep down, every trader believes the next trade could be the one. That's the loop. That's the business. And here's the craziest part. The market isn't even evil. It's indifferent. It doesn't care if you win or lose. It just reacts to human emotion, fear, greed, hope, ego. It's a mirror. And for most traders, that reflection is uncomfortable to look at. The dark side of Forex isn't just the brokers or the scams. It's the part of human nature that refuses to accept uncertainty. The need to be right. The need to win. That's what keeps the wheels spinning. So maybe the question isn't, can you beat the market? Maybe it's, can you beat yourself? Because the truth is, those who last in Forex aren't the smartest or the fastest. They're the calmest. They survive by mastering patience, not prediction. By thinking in probabilities, not promises. By cutting losses fast and letting wins breathe. And yes, by knowing exactly how the game is rigged and playing anyway on their own terms. So the next time someone tells you Forex is easy money, smile. Because now you know better. You know the rules, the traps, and the psychology behind the pitch. The Forex market is like fire. In the right hands, it cooks dinner. In the wrong hands, it burns the house down. So use it wisely. Study it deeply. And never forget what side of the table you're really sitting on. Because the moment you do, the house wins again. And maybe that's the final lesson. In Forex, as in life, knowledge isn't power. Applied knowledge is. So take what you've learned here today and make it count. Trade smarter. Question everything. And if you've ever felt the market was against you, now you know why. The dark side doesn't disappear when you see it. But at least now it can't hide.